Thank you. Good afternoon, everyone. So I think my predecessors have done a lot of work for me already. They have mentioned the macroeconomic environment. They have mentioned international policy settings. I've heard about leverage and political risk, which is really what we at Moody's think is going to drive sovereign ratings globally during 2018. And what I'll do today is really explain to you how that global picture really focuses on Asia and how we see credits evolving in a region. The timing today is particularly fortunate because we've just published our global sovereign outlook. So this is really once a year taking a forward-looking view about the drivers of credits globally and in the region, and I'll take you through some of that. Through these four themes that we've heard about, and with a similar tone, I think, that the global macroeconomic environment is relatively favorable, and this region particularly benefits from that. And that in that environment, maybe there is an opportunity for some governments at least to carry on with some of the reforms that would otherwise be somewhat more difficult. And here I think our assessment is mixed, and we do expect some reform progress in some areas, but really some of the difficult aspects, the more structural really hurdles to reforms are likely to remain. Next, I would observe that despite what is a relatively benign macro environment, leverage is still high, and we do not expect that to rise. And I think that has then implications when we think about the next downturn, because that downturn will come at some point over the next few years, about the policy space and the shock absorption capacity that there is in the system. And last, I will talk about political risk. There are many sources of political risk, as we've heard earlier. I will focus here on Korea and the potentiality of a Korean conflict and explain to you how we look at that in terms of credit implications. So, starting with that global outlook, this is a picture of our ratings, and we rate globally 137 sovereigns, and so that's the big wheel there on that chart. And so the green patches are our positive outlooks on our sovereign ratings, the red ones are negative outlooks, and then the deeper the shadow, the shaded area, the lower the rating. So as you can see globally, it's a pretty evenly spread kind of balance that we have about 3/4 of ratings on stable outlook. And over the last year, we have taken more negative actions, downgrades or negative outlook than positive actions. But that is, things are balancing out. And so looking at 2018, we think, as I said, that the outlook for sovereigns in general is stable. So we think that the risks are broadly balanced. For the region in Asia Pacific, so the right-hand side part of the chart, the zoomed in part there, so we have 25 sovereign ratings here. And here you see definitely much more stability with even some pockets of positive risks. So we have a positive outlook on the ratings for Indonesia, India, and Vietnam, and we have one negative outlook, which is Sri Lanka at the moment. Drivers behind that assessment, and starting, and I'll be relatively brief, we've just heard from Mr. Mann kind of an impression of the macroeconomic picture, and I would very much agree with what we heard there. But it is for sovereigns, for governments, a relatively benign environment here, with growth at about 3% globally, and for Asia at around 5% in the region. Growth forecast that we have revised upwards over the last year, as we had underestimated that pickup in global trade. Really the momentum that has come through the past year has been stronger than we previously thought, and so Singapore certainly, but also Hong Kong, Taiwan, Korea, and Malaysia are benefiting very strongly from that. And you see that a difference with other regions where our forecasts have been much more static, and that momentum really hasn't fed through necessarily. That need not affect our rating assessment in that we do expect Asia to benefit particularly from a global macro environment that is positive because of its trade reliance, but more fundamentally as well, because this is a region where we see what we call relatively high economic strength. And so economic strength is a part of assessment of our sovereign ratings, where we look at really the shock absorption capacity, what is provided by the diversification of the economy, the income levels, the competitiveness of each of these countries. We rank that on a scale going from very high plus, where we have Australia, and the US and Switzerland, and that's it globally, to very low minus, where we would have in the region here, none at all. We have some very lows with typically very small economies like Solomon Islands. But what you can see here is that on average, we have a lot more Asia-Pacific sovereigns with relatively strong, really economic conditions, shock absorption capacity compared to the rest of the world. So we do expect that in an environment like today, these are really the sovereigns that will benefit. On top of that, compared to this time last year, I think some of the risks, some of the threats to that economic strength have diminished, if not disappeared altogether. And here I'm thinking in particular about significantly adverse US policies as regards trade, as far as trade is concerned. So this time last year, we were thinking of the eventualities of a border adjustment tax from the US that would have potentially come with a very sharp appreciation of the US dollar. Nowadays, I think the likelihood of such policies being undertaken has diminished very strongly. And certainly, as we were discussing earlier, the meetings that are happening right now as we speak in Beijing seem to be conducive to at least a status quo, if not maybe some improvements in some areas in trade relations. China deserves a few minutes in that region, in that what drives really our assessment of economic strength there is not related to a global trade environment. China is a very much kind of economic-driven economy. It's a domestic-driven economy. It's also one that operates on a different system. And there, what we are seeing is that, again, we've been surprised relatively on the upside as far as growth is concerned, with very resilient growth at and above 6.5%, aided by significant policy stimulus. And there are two sides to that story, really. One positive side is that the policy has been effective in really maintaining stability in China. So I was maybe somewhat surprised that a third of you are thinking of a potential hard landing in China in 2018. We would put a much, much lower probability to that, because we do think that the willingness by the Chinese authorities to support that economy, to ensure really strong growth, is very much there. And the capacity is also there, as we've seen in the last couple of years. The mirror image of that, the downside of those aspects, are then what it means for leverage in the economy, and I'll talk about that later. What it means then for contingent liability risk for the sovereign, and that those aspects are behind the downgrade of China's rating that we implemented earlier this year, when we downgraded the rating to A1 from AA3. So overall, a benign macroeconomic environment that opens a window for reforms in economic reforms, fiscal reforms, and in a wide range of areas. And there are indeed reforms on the table and reforms being implemented already. China itself has a very, very vast agenda, typically defined in the 5-year plans, and that then gets refined and precised over the next few years. We've seen a shift from economic rebalancing to deleveraging to now maybe more emphasis on financial risk and containing that. But overall, that's really a consistent agenda of reforms in China. And after the CPC meetings just a few weeks ago, we think that really, on the whole, policy continuity will prevail, with, it seems, some concentration of power, and with, it seems, still a very, very significant role of state-owned enterprises in driving that economy and driving the policy objectives in the country. In other parts of the region, I think there are interesting aspects of reforms that are just as diverse, and with, in particular, a number of governments that are aiming to broaden the tax base. And here, I'm thinking about some of maybe the lower incomes, but we certainly hear about measures aimed at improving tax collection, tax administration in Indonesia, in India, in the Philippines, in Sri Lanka, really across the board, where typically these governments collect about between 10 and 15% of GDP in revenues, and so with scope to improve that, to enhance that, and then that would allow them to unlock, to freeze up some financial means to then spend on very necessary infrastructure and other investment. So far, the effects of these measures have yet to be seen. I think India's GST is an example there where the teething problems are certainly clear at the moment, and time will tell whether that really is a measure that effectively boosts tax compliance and revenues for the government. Other aspects of reforms in the region deal with very global topics around inclusive growth, and Korea and Japan are taking a stand on that, are taking really their own approach to that. The Korean government just announced this morning some subsidies to SMEs, to finance, to deal with a very significant increase in the minimum wage. The government has also announced a very large increase in public sector jobs. It is a policy that seems somewhat different from that of previous administration in the context of still very clear fiscal prudence, and so cuts will be taken elsewhere. And again, so far, our assessment is that the credit implications of those policies altogether is broadly neutral. For Japan, the priority is to probably deal with this aging of population that is happening at a very fast pace, that has been happening for some time, and bringing in the labor force, so women, and keeping in the labor force maybe the elderly part of the population. With some success so far, some mitigated success as far as participation rates have increased, but wage growth is still very, very low. So a mixed track record as far as reforms are concerned, and so we think that really the reform effort will probably be clearest where the pressure is most intense, and here that would be in our space in countries like Mongolia, which we rate at CAA1, in Sri Lanka at B1, where in particular with the help of an IMF program, there's a very clear agenda to improve fiscal discipline and reduce reliance on external financing. But for us, sovereign analysts, then it tends to come down to what does this all mean for risk on the sovereign balance sheet. And what we are seeing is that despite the relatively robust growth, despite this willingness and appetite to implement some measures, debt is still relatively high. And so what this shows you is the change in government debt over the last 5 years on the horizontal axis. The size of the bubble is the size of the debt, government debt to GDP ratio. And on the vertical axis is then the debt affordability, so measured in terms of interest payment to revenue ratios. And you see here that most of the bubbles are towards the right, so debt has increased, and we do not see debt really falling, government debt falling in general. We see a plateau at current levels, at levels that then are much higher than they would have been in previous cycles, at this stage of cycles in previous episodes, which then, as I said, raises questions about capacity, fiscal flexibility to absorb future shocks when they will come. In this chart, what concerns me particularly is really the frontier market part of that chart. So again, Mongolia, Sri Lanka, Vietnam, as well as Cambodia and the like, we rate a number of those. And globally, what we've seen is that in the last few years, the debt affordability for these sovereigns has weakened very significantly. So whilst at the beginning of the decade, if we split the world into 3 groups, advanced economies, emerging markets, and frontier markets, everyone on kind of average basis was paying around the same on their debt, about 5% of revenues. We've seen then a decoupling, really a divergence, with advanced economies debt affordability, if anything, improving with low interest rates in recent years, but then this debt servicing costs for emerging markets rising towards 7.5% of revenues, and for frontier markets towards 9%. So these are heavy costs to carry in an environment when then we do think that interest rates will not remain as low as they currently are. for China, the debt is not on the government's balance sheet. We estimate that government debt is around 40% of GDP, so a very moderate level. But the debt, as you well know, is on the corporate's balance sheet. And that is then a source of contingent liabilities that we have taken into account in downgrading the rating earlier this year. And so what we're looking at now is really the quality of capital allocation in China, the productivity of investment that is happening in China, and the credit intensity that this supposes. We've seen a very sharp increase in credit intensity in China, so diminishing productivity of one unit of credit, and that has come with higher risk, higher contingent liability risk. The authorities are taking measures to address that, to focus on that, and we think the measures will likely be effective in that they will taper the leverage. They will probably bend that leverage curve. We do not think that the measures will be enough to really reduce leverage altogether because of the concerns of keeping really growth going and the necessity of relatively rapid credit growth to achieve that. Okay, sorry, I've jumped too far, but I'll, before I show you the next presentation, I will finish on geopolitical risk. And as I said, I wanted to focus there. There are many aspects of political risk around the world. I wanted to focus on China, on Korea, sorry, as one particular aspect here. So we would agree that the probability of a conflict in the Korean Peninsula is low, and so it is not our baseline scenario. At the same time, we do think that this probability has increased over the last few months, and that really our capacity to predict, to assess that probability has diminished given the very, at times, really strident rhetoric. So from that, and from the thinking that whilst a low probability Korean conflict is probably a very big impact risk, we want to look at really what the implications would be. So starting from Korea's role in the world, in the global economy, in global financial flows, where Korea accounts for about 3% of trade flows, about 3% of oil consumption, much more of LNG consumption. It's a big consumer of LNG, and is a significant really node in a number of sectors, in particular electronics. We can derive then what the implications, what the spillover effects of a Korean conflict will be on the region and globally. And we thought through that in terms of really credit implications, in terms of economic strength, as I explained earlier, in terms of fiscal strength, what the impact would be in terms of fiscal cost for governments around the world, what the impact will be in terms of then access to markets and liquidity and external vulnerability risk for sovereigns. And I won't go into too much detail on this. I will just draw your attention to 2 points. One is that you see Vietnam here in dark orange in a number of places. And that's one of the conclusions of that work, that yes, the Korea would be very much affected, of course. Yes, some of the neighbors, China and Japan in particular, if they are involved in the conflict, would be affected. But maybe one that is not top of mind is Vietnam. And Vietnam is affected because of its integration in the same supply chain as Korea, because of the extent to which it exports to Korea. So the very rapid growth rates that we've seen in Vietnam in recent years are potentially threatened quite significantly by a Korean scenario. The other aspect is Japan, whereby we have seen stabilization in government debt with nominal GDP growth picking up. A Korean scenario would really significantly change that. And so there again, we think that in terms of sovereign credit implications, Japan is towards the top. So with that, I will conclude and really recap in terms of talking about relatively balanced risk with a macroeconomic environment which is much more favorable than we saw this time last year for emerging markets as well as advanced economies, in particular for Asia. And a series of set of risks that are there, some potentially more immediate, even if low probability, such as a Korean conflict, some more remote, which really relate to China's leverage and China's dealing with its leverage and the potential unraveling of that it will mean over the next few years. Thank you.